there's really no precedent for what we're going through. Nobody knows how this is going to play out. So how do you take it day by day, if you will?
Well, every situation is going to be unique to investors, but we're giving advice to our investors to look at three things right now. And one is look to tax loss harvest. There's plenty of things to sell in a portfolio. This has not been the case in years past, where there's been just outsized gains in the S&P 500 and across virtually every sector. We're telling people to dollar cost average. Don't try to time this market. This volatility is impossible for even the most seasoned professional investors to time accurately. And to bargain hunt, to look for areas of the market that may have sold off more aggressively than they needed to because people are trying to raise cash in any way or shape they can. So there's some real valuations out there that are pretty attractive now.
Meantime, hedge fund manager Bill Ackman was on Bloomberg Television earlier. He sounds fairly optimistic. Take a listen to what he had to say.
It's obviously a very volatile market. We can buy and sell different securities. We could put a hedge on them again in the future. All of that being said, I think the most likely event is we're a long-only investor. We intend to, we believe in the country. I think the country is getting to the right place on this issue.
So, Jay, talk to us a little bit about whether you share that sense of optimism. Markets are going to return at some point, but nobody knows how long this is going to last.
We do. The time frame is the most concerning thing right now. People don't know how long they're going to be staying at home. People don't know how long these companies are going to have to stay afloat with essentially emergency credit from banks or from the Fed. But we do know 3, 5, 7 years out, the U.S. economy is incredibly resilient. It has tons of human capital and talented people and entrepreneurial companies. So this will rebound. And that can be a real advantage. We've spoken to a lot of investors who, frankly, had been a little bit nervous heading into 2020. A lot of people have been keeping more cash on the sidelines. And if they're looking to invest now, these are pretty attractive valuations, barring that they don't think they need that money in the next 3, 5, or 7 years. Time is a real asset if you have cash right now. And it's a real risk if you don't have cash or if you need cash in the short term.
So, Jay, I mean, that's a great point, but obviously you have to understand, too, that there is a lot of fear, a lot of concern in the market about how deep this recession could be and how long it may go on. For those folks who maybe are a little bit nervous about putting cash to work or maybe are thinking about selling out of positions, I mean, what's the main sort of selling point that you give them to expose themselves to that potential risk at this particular moment?
Well, look, for long-term investors that can stomach the risk, we see this as a really transformational period in the economy. You have very attractive valuations for segments like the video games and esports segment, which is sold off 15%, social media, which is sold off 30%, e-commerce, which is sold off 25%. And all of these themes have only accelerated in the last few months. People are at home playing games with their kids on their PlayStation 4. You have baby boomers and the silent generation learning how to buy things on Amazon so they can get deliveries to their house, and FaceTiming and using Twitter. So this is a real disruptive moment in technology where more people are using these new techniques to get through their everyday lives. And then the companies that are involved in that are selling at a discount. So this is a real inflection point that I think investors, if they can, should take a close look at.
That's a good point. Maybe you can expand on that a little bit. I mean, when we went through the global financial crisis, one of the sort of outcomes of that is it gave rise to a whole new group of sort of, I guess you could say, technology platforms, or whether you talk about the sharing economy, the gig economy, things like Bitcoin and digital currency. What do you envision? I mean, if you can sort of look into your crystal ball here, that could be some of these more technology sort of leaps that we could make once we do sort of get through this period.
Well, I think we'll be set back on the path that we've been on for the last 5 years. So one of that is the shift from brick and mortar retail to e-commerce. This is a theme that's been going on for a decade already, and yet only 10% of consumer sales is happening online versus in brick and mortar. So the 90% of that market is left. It's automobiles, it's groceries. Those haven't really moved online, but now I think there really is a strong push to do so. And the people that have been the laggards, that have been holding out to make those purchases online, are really being forced to very quickly get comfortable with that. The second one is video games. People have been playing video games for 4 decades now, but it's still often seen as, something for teenagers or for the Gen Z generation, not for adults. But if you're a parent stuck on a couch with your kids, for the 30th day in a row, you're absolutely going to play an NBA game with your kid, or or a strategy game with your kid on a console, because it's a way to bond and it's a way to have fun on your couch. And that trend, I think, is only going to continue to accelerate as people continue to leverage technology in their homes.
So if that's where you see the opportunities, Jay, where do you think investors should be pulling back? Because it's certainly not all opportunity if you look across the board, even in the tech sector.
Well, I think there's still a lot of uncertainty in a lot of sectors out there. I think in the materials sector, there's a lot of debt out there. There's a lot of uncertainty around how much consumption there will be of different commodities. So I think there's a lot of risk in that space. What you really want is to look at companies that have the cash and have continued cash flow to survive what could be a months-long interruption. And unfortunately, that's not a lot of the companies that are heavily indebted or that have a lot of fixed costs. But if you look at those companies more on the technology side, on the software side, on the chip side, on the social media side, one, they have cash, and two, they're continuing to make cash flow even in this pretty disruptive environment. So that just makes them much safer than more of the kind of physical businesses that are out there right now.